Hello and welcome. My tax accountant is here to walk you through the world of UK tax for the 2025/26 year. Now, whether you're on a payroll, running your own business, or doing the freelance thing, really getting a handle on tax is absolutely key to your financial well-being. So, let's get you set up for success.
All right, let me kick things off with a pretty big question. Are you, right now, accidentally paying more tax than you actually need to? It's a surprisingly common issue here in the UK. A lot of the time, it just comes down to simple mistakes or, not quite understanding the rules. Our goal today is to make absolutely sure that you are not one of those people.
So, here's what we've got on the cards. We're going to kick off with the 5 key UK taxes you need to know about. Then, we'll see how they pop up in real-life situations. After that, we'll dive into some really smart ways to save tax. And finally, we'll talk about how getting an expert on your side can make all the difference. Sound good? Let's jump in.
Okay, first up, the 5 big ones, the core taxes. Honestly, understanding these is your first step. It's the foundation for really taking control of your money.
And we're starting with the absolute giant of the tax world, income tax. This is the main way the government funds, well, everything, public services, you name it. But here's the good news. You don't pay tax on every single penny you earn. For the 2025/26 tax year, you've got what's called a personal allowance. Think of it as your tax-free chunk of income, and it's set at £12,570. So what happens when you earn more than that allowance? Well, that's when the tax bans kick in. In England, Wales, and Northern Ireland, anything you earn from that 12,571 point up to about 50 grand is taxed at 20%. That's the basic rate. But then, look at that jump. Once you're over 50,270 pounds, you're into the higher rate at a whopping 40%. That leap right there, that is exactly where smart financial planning can save you a fortune. Oh, and a quick heads up for our friends in Scotland. Remember, you guys have your own set of bans and rates, so they'll look a little different.
Next on our list is national insurance, or NICs as you'll often see it. If you've ever looked at a payslip, you'll have seen this right next to your income tax deduction. So what's it for? Well, these contributions are specifically for funding things like our amazing NHS and, really importantly, they build up your personal entitlement to the state pension later in life. It's paid by pretty much everyone who works, whether you're employed or self-employed.
Now, the amount of national insurance you pay, it really depends on how you work. If you're an employee, you'll be paying what's called Class 1 contributions. For most of your earnings, that's at a rate of 8%. If you're self-employed, you'll be dealing with Class 4 contributions, which are a little higher at 9% on your profits. So it's all directly linked to your employment status.
Okay, let's talk about a tax that affects all of us whenever we buy something, but it is a massive deal for business owners. I'm talking about value-added tax, or VAT. It's that extra bit added onto most goods and services. And seriously, if you're running a business, getting your head around VAT isn't just a good idea, it's absolutely essential.
That isn't just one single rate. It's got a few different layers. The standard rate, the one you see on most things, is 20%. But then you have a reduced rate of 5% on things like home energy or children's car seats, and some items, like most food and kids' clothes, are zero-rated. Now, for any business owner listening, there's one number you need to burn into your memory: £90,000. That's the VAT registration threshold. If your annual taxable sales go over that amount, you are legally required to register for VAT, charge it, and pay it to HMRC.
All right, this next one is specifically for those of you who run a limited company. This is corporation tax. It's a direct tax that your company pays on its profits. And that's a really crucial difference, right? If you're a sole trader, you pay income tax on your profits. But if you're a limited company, your company pays corporation tax.
So, how much is it? Well, the corporation tax rate actually changes depending on how much profit your company makes. For smaller companies with profits up to £50,000, the rate is 19%. For the really big players making over $250,000 in profit, the main rate is 25%. But what about the companies in the middle? Well, there's a system called marginal relief. You can think of it like a sliding scale that smoothly takes your effective tax rate up from 19% towards that 25% mark. It stops there being a sudden, harsh jump in your tax bill.
And last but not least in our Big Five, let's talk about capital gains tax, or CGT. Now, this one isn't about your day-to-day income. This is a tax you pay on the profit you make when you sell something, an asset that's gone up in value. Classic examples are selling a second home, maybe a buy-to-let property, or cashing in some shares. The key word there is profit. You're only taxed on the gain you've made, not the total amount you sold it for.
The rate of capital gains tax you pay depends on 2 things: your own income tax band and what you've sold. For most assets, it's either 10% or 20%. But, and this is a big but, for residential property, the rates are higher. We're talking 18% or 28%. Now, for the good news, everyone gets a tax-free allowance each year, which is called the annual exemption. And for this tax year, that's £3,000. So you can make up to £3,000 in profit before you pay a single penny of capital gains tax.
Okay, so we've got the theory down. That's the boring bit out of the way. Now, let's make this real. Let's see how all of this stuff actually plays out in the real world by looking at some super common mistakes and, much more importantly, how you can sidestep them.
Let's kick off with Tariq's story, because honestly, this happens to so many people. You start an exciting new job, you're buzzing for that first payday, and then it lands, and you see you've paid a huge chunk of tax. You're left scratching your head, wondering what went wrong. Well, 9 times out of 10, the culprit is something called an emergency tax code. And the financial hit from this simple admin error can be massive. I mean, look at this. Tariq was overtaxed by £1,800 in just his first 3 months. So what's happening? An emergency tax code is basically a temporary code HMRC gives you when they don't have your details, and it assumes you have no tax-free personal allowance at all. So you end up paying 20% tax on everything you earn right from the start. A simple little mistake, but one with a very, very real cost.
So, how can you make sure you don't end up in Tariq's shoes? Here's a pro tip for you, and it's a super simple one. When you leave a job, you get a form called a P45. Guard it with your life, and give it to your new employer on day 1. It has all the info they need. Now, if for some reason you don't have one, don't panic. Just make sure you ask for and fill out a starter checklist form properly. It's a 5-minute job that can save you a world of financial pain.
Okay, now let's turn to Elowen. She's a freelance florist based in London. She took the leap into self-employment and absolutely loved the freedom it gave her. But that freedom comes with a whole new set of responsibilities. All of a sudden, she was in charge of her own tax through the self-assessment system, and she had to get her head around new rules like making tax digital, which basically means businesses have to keep all their records digitally and file their returns using special software. It can be a massive shock to the system if you're not prepared.
And for lots of freelancers and contractors like Elowen, there's this other really tricky layer of rules called IR35. It's a bit of a minefield, but essentially, these are rules that HMRC uses to figure out if you're genuinely self-employed or if you're what they call a disguised employee for tax purposes. They look at 3 key things. First, substitution. Can you send someone else to do your job? Second, control. Does your client dictate how, when, and where you work? And third, mutuality of obligation. Do they have to give you work, and do you have to accept it? If the answer points towards you being more like an employee, you could be deemed inside IR35, and that means you get taxed just like one.
Right, we've seen the pitfalls and the tricky parts. But here's the good news. With just a little bit of forward thinking, you can legally and proactively shrink your tax bill. So let's get into the exciting bit. Some really smart strategies to help you keep more of your hard-earned cash where it belongs, in your pocket.
Look, being tax efficient isn't about some secret trick. It's about building good habits. First, make a habit of checking your tax code. Is it correct? You can see it on your payslip or online. Second, track everything. Get some simple software and log all your income and expenses as you go. This is a must for making tax digital anyway, so get ahead of the game. Third, max out your allowances. Don't wait until the end of the tax year to use your ISA and pension allowances. Get in there early. And finally, please, file your tax return early. Don't leave it to the January deadline rush. It gives you peace of mind and time to plan for any payments.
And you know, there are some absolutely fantastic opportunities to save that so many people miss. If you're self-employed, every single allowable business expense, from your van's fuel to your website hosting, lowers your taxable profit. Every pound you put into a pension gets a top-up from the government in the form of tax relief. You can stash away up to £20,000 a year in an ISA, and all the growth is completely tax-free. There's even something called the marriage allowance that can save some couples over £250. And that little side hustle you've got, the trading allowance, might make the first grand you earn from it totally tax-free. Don't leave this money on the table.
Now, this case study of a designer named Celine really shows how powerful it can be when an expert helps bring all these strategies together. Honestly, she was completely drowning in paperwork. She'd missed a tax deadline, she had no idea if she should be VAT registered or if she should set up a limited company. But the team at My Tax Accountant came in and just created a clear plan. They didn't just fix the immediate problem of a missed deadline, they looked at the whole picture. They sorted her VAT, helped her structure her business for growth, and this is the amazing part, they found over £2,800 in R&D tax credits she had absolutely no idea she was entitled to. The result wasn't just a tax saving of over $5,000, it was clarity, confidence, and zero stress.
So the big takeaway from all of this is that you absolutely do not have to try and figure out this complicated world all on your own. Getting professional help isn't just another cost, it's a genuine investment in your financial future, and just as importantly, in your own peace of mind. If you're ready to take control, ditch the stress, and make sure you're being as tax efficient as you can possibly be, then please get in touch with the fantastic team at My Tax Accountant. You can give them a call, send a WhatsApp, or drop them an email. The details are right there. And for more brilliant tips just like these, make sure you hit subscribe on their YouTube channel. Thanks so much for joining us.